So
Thank you.
I believe it's time to bring in Abigail Doolittle. Is Abigail here? Because I see some of our panelists are here.
Hi, Dale. I am here. And
Hi,
that
Oh,
was a
hi,
great
Abigail.
conversation you all were just having. I
Uh,
love bringing in that spiritual aspect of life and the little things that make life so great.
and it's you're one thing that makes Bloomberg great.
Oh, thank you. That's so kind of you. I really appreciate that.
Abigail. So, I followed you over the years for your career in, as a technician and as an anchor, and you can do it all. You're you're a Renaissance woman.
Well,
So,
thank you.
and you have your hands full today, Abigail, with this panel.
I would
I think
agree.
there's going to be plenty of, alpha males that you're going to be dealing with, and really appreciate that you're here to conduct this panel discussion with Peter Schiff and Anthony Papio and Mark Yusko and Mark Dow. And have I forgotten anybody that's going to be with us?
And Peter
Daniel
Schiff.
McCall. Peter Schiff,
Yeah.
of course. Peter I'm really looking forward to it, and I'm just going to come off camera and take it away, Abigail Doolittle.
Well, thank you so much, Dale. I really appreciate it. It's a real honor to be here to moderate this panel. And my gosh, what a topic that we are going to be discussing. COVID, stimulus, and the US elections, what to expect from the market. So we can talk about pretty much anything under that title and the topic that we have chosen here. And, I would say this year, from a market standpoint, the volatility is just incredible, especially recently. That huge gain in August, completely given back in September. And this week, the intraday volatility, just really, really hard to follow, especially on air. You can go on air planning to say one thing, and then you're talking about something completely different because the markets have changed. I have, through the years, learned that volatility often means uncertainty. In other words, nobody knows. Nobody knows what is possibly next around the pandemic. Nobody knows around the elections. And so neither the bears nor the bulls are taking charge this year. If you look at the S&P 500, into the February peak, it was up 6%, then down 35%, then up 65%. Now, more recently, down 10%. The S&P 500, with all of those moves, is about flat. So I really cannot wait to hear what all of you think in terms of what you do know about what's been going on and going forward. And we are in this pandemic, this really unusual time. So I'd really like to extend my sympathies and my compassion to everybody who's been affected by it on a personal level, beyond the huge shift that we've seen in life. It's such a difficult time for so many of us. So again, I'd like to extend my sympathies and compassion to those affected directly, because I think that we all have been or know somebody who has been. But in crisis, opportunity comes. So I love the fact that we're doing this over Zoom, because if we were in some fancy building on a fancy stage, we wouldn't have the intimacy that we have here. I told Steve and Joe that my goal for this was really to create what I used to experience back in the day on trading floors, that ultimate, conversation that just comes out of nowhere, that real chemistry, because people have skin in the game. You're also young, you're foolish. I don't know how young we are. We might still be foolish, I'm not sure. But that's the idea. Let's keep it, casual. And because we do have big opinions here, feel free to really get in there and spar. And because it is such a broad topic, and because there is so much going on right now, I thought we could maybe start macro with the economy, the system, then maybe, I think of stocks as the least essential asset class, perhaps the tail of the dog, and then move toward, currencies, bonds, and commodities. And I will ask a few questions on these topics, to our panelists in particular, but if something is said and one of our other panelists wants to jump in, please just raise your hand and I'll make sure that you're heard on that. So without further ado, I'd like to just briefly introduce each of our panelists, even though I don't think that anybody really needs too much of an introduction. So starting off with Peter Schiff. Peter is the CEO and Chief Global Strategist of Euro-Pacific Capital, among other financial businesses. Also the principal host of the Peter Schiff podcast. And I think Peter is probably also known as one of the most ultimate gold bulls out there. So we're very excited to gain Peter's insights on gold and where it's going and what's going to happen with the economy. Mark Yusko, the founder and CEO, Chief Investment Officer of Morgan Creek Capital Management, which manages about $2 billion in discretionary and non-discretionary assets. And I believe, Mark, I'm looking forward to hearing more on your views, that you are a crypto and a blockchain bull. So I've moderated other crypto and blockchain panels, and they get feisty. So I'm looking forward to this. Anthony,
we can do feisty, Abigail.
Great. I'm looking forward to that. It'll be a lot of fun. Maybe we will use our entire hour and a half here. Anthony I love that. Pompliano, also a founder of Morgan Creek Capital Management and a partner there through the acquisition of Full Tilt Capital. Guessing, Pomp, that you also are a fan of crypto. So looking forward to hearing what you all see in blockchain and crypto. And then Daniel, if I mess up your name, please forgive me. This is not a strength on my part. Daniel Lecaille.
Beautiful.
Great. Okay.
Better. Absolutely.
And Joe trained me well. Who is a PhD trained economist and a fund manager, also the author of 2 best-selling books. And Daniel frequently appears on the air, including Bloomberg and other networks. And then finally, but not least, Mark Dow, who I absolutely love on Twitter for his blend of facts and observations and inspiration, golf shots. I love to golf, so I love those golf shots that you put out there. And also your kindness. I really like your kindness. You are the author of Behavioral Macro Twitter feed and blog. You also run the Dow Global Advisors, a family office. You have 30 years of experience, and you started out in DC at the IMF and Treasury. So Mark, I want to start with you, because if we're going to start with the economy and we're going to start with the system, I have been told that you correctly predicted the recession that we're seeing here in 2020 ahead of time. So I'm wondering what your tool or set of tools was to predict this downturn that we've seen, and what those tools tell you about going forward to 2021.
Must be talking to you, Mark Yusko.
I
didn't predict the downturn. I didn't predict the pandemic.
All right. Well, I definitely didn't predict the pandemic, but now, Abigail, which Mark?
Oh, well, actually, Mark Dow, I was told that you predicted the recession, not the pandemic, but the recession.
No, I didn't. I mean, I think the recession is a function of the pandemic, and that truly came out of left field. So I didn't predict that. No.
Okay, so that was not showing in your tools at all.
No, there was nothing. I mean, once the market started to roll over, it was clear that we were overbought and those kinds of things. So in terms of risk management, from a risk management perspective, it was what you recognized it as it started to happen. Just a little bit like recently, we saw the stock market got pretty exuberant, and as you get more exuberant, and I'm talking about short-term exuberant, right? You're more vulnerable to a pullback. You never know exactly when it's going to happen. You just hope that you recognize it quickly as it starts to happen and adjust your risk accordingly.
Okay, so that's certainly terrific, because having worked in asset management a little bit, it really is all about that portfolio allocation. Well, Mark Yusko, let's now bring you in. And so we have, in terms of the recession and then the stimulus, a lot of folks are saying that we have this problem now that we don't have new stimulus coming out of DC. Do you think that this is going to show up in the numbers? Because it's sort of interesting. The economic numbers have come in a little bit over August and September, what we've seen of September, but not horribly. Do you think it's going to start to show up?
Look, I think we're just at the beginning of a real problem. And Abigail, we look back probably for a year and a half and started seeing real signs of deterioration, economic growth, income growth, spending. And, the pandemic, as Mark said, really was the trigger that plunged us into recession. Now the problem is the response is triggering potentially a depression. And I just got done doing this 6-week-long road trip, did a series of webinars while I was out there. And I'm telling you, this narrative that there's a recovery, no way, right? The pain and suffering we witnessed, we went through 14 states over 6 weeks, and it's bad. I mean, it's bad on Main Street. Wall Street feels like it's doing great. They're not really doing great because that's money illusion. When you denominate the S&P in gold, you've actually lost 44% over the last 2 years. If you denominate in Bitcoin, you're down way more than that. So there's this illusion that stocks are ebullient and nominal prices are high, but on Main Street, it's horrific out there. Homelessness surging, people out of work. We were in Santa Fe, New Mexico. 1 out of 3 businesses shuttered, right? Talking to other shopkeepers, both of them said, look, we're going to close by the end of the month. We tried. Went to the Grand Canyon, 2 people at the lodge we stayed at, went to a hotel in Tempe, Arizona, 3 people in the whole hotel. Craziness.
So that's super interesting because here in New York City, and you're bringing in the depression word. I was planning on bringing that up with Peter. Here in New York City, and I left the city pretty early in March, and then I came back very early in April when I saw things were working through in a workable way. But where I am, at least, I'm not seeing that much change. I would actually say that there's a festive sort of feeling here in the city, especially once the outdoor dining started. And now there's an influx of people. Now, if I go to other parts of town, yes, it feels a little bit more difficult. And I think that one issue facing the city is real estate, because even before the pandemic, there was a lot of empty retail space. Now you have to wonder about the restaurant business and that trickle through and the downstream. Daniel, you are also an economist, a PhD economist. So why don't you, if you can, bridge what Mark just talked about, what he's seeing in other parts of the world, what I'm seeing here in this city. And my thought on the city is, and in terms of the stimulus at the Fed and the initial stimulus out of DC, is if you liken it to a cast on a broken leg, if you take the cast off, you hope the leg is fixed. So right now there's this sense here in the city, at least, that my perception of it, that it's okay, but certainly beneath the surface, so many people are being hurt. So everything that you know about economics from an academic standpoint, can this cast, if you will, work, or are we going toward that depression that Mark's talking about?
Yes, thank you very much. I think both of you are right. What we are seeing is the typical shape of a K-shaped recovery.
Okay, I haven't heard that one.
A K-shaped recovery is that in which the stock market, the high-end professionals, high added value businesses recover very quickly, rapidly. In fact, actually much faster than what many of us could have expected, because they are the biggest beneficiaries of easy money. Absolutely. On the other side, what we see is exactly what Mark mentioned. If we look, for example, at the Eurozone, about 25% of businesses are in technical bankruptcy. In Germany, which is supposed to be the strongest economy of the European Union, about 500,000 businesses are considered zombies. That is, that they're unable to pay interests of their debt with operating profits. So it's really, really challenging, because we tend to forget that the so-called recovery, particularly 2018, 2019, was led by travel and leisure. About 37% of the GDP of the developed economies came from an improvement in travel and leisure, which is being absolutely devastated throughout the developed economies, but not just. I think that the other element that is important is that is this concept that you just mentioned about the broken leg and the cast. Is unfortunately that Federal Reserve policy, that central bank policies and demand side policies from governments are not a cast. They're simply a placebo, is a little bit of a drug. So it doesn't even generate the impact that a cast can have in terms of healing. Nothing has been healed throughout this process, because the diagnosis with which central banks and governments started was that the economies were in great shape in February 2020, and that was a false rhetoric.
Pomp, I saw you smiling to some of that commentary. What were you thinking?
I'm thinking a lot about Harvard economist Raj Shetty just came out with a tool a couple of months ago. And what he's basically been tracking is this exact K-shaped recovery. And so if you really start to dig into some of that data, it's pretty horrific. And so if you look, let's say at employment, for example, high income earners are basically back to full employment, or not full employment, but employment that was pre-pandemic levels. So the recession's over if you're rich, right? But if you're a low income worker, you're still down 20 to 25% in terms of that employment level. And then when you start to break out things like education or spending, right? One of the really scary parts here is not only are 20% of businesses still closed in the United States, and then we get this kind of divergence between high income workers back to work and low income workers not. But when you look at consumer spending, if you actually break it out by income bracket, the lowest income brackets are actually spending more money now than they were pre-pandemic, and the highest earners are spending less. So when you actually start to break out things, kind of total consumer spending, high income earners are spending about 10% less than they were pre-pandemic, but low income workers are spending about 5% more than they were. So you literally get a situation where kind of the people who are most vulnerable in society, every single time that the Fed acts, we're actually punishing them, right? We're quite literally pushing them deeper and deeper into a situation where they just can't catch up. And then also because of the challenges of the pandemic, they're having to spend more money, right? I think one of the fallacies when the Fed talks about inflation and other things is everyone doesn't experience inflation at the same rate. Right. And so if you really look at coming out of 08, 09, there's a lot of studies now that have been published that show the lowest income brackets in the United States or in Europe, they could have experienced as high as 6 to 10% inflation coming out of 08, 09 crisis. The highest income brackets were, kind of that 0.5% to 1.5%. And so those are kind of those CPI numbers and things that we look at. Well, if we're now talking about a situation where the Fed wants a persistent over 2% inflation, and they're going to get there, let's say that they can get there, and that's debatable, but if they can, then all of a sudden you're talking about a low income bracket that could be experiencing, 10, 12, 15% inflation. And it just goes back to this idea, I think, Daniel, Mark, and Mark both kind of hit on it. There's two Americas, right? And it's quite literally expensive to be poor right now in America, which is really, really sad. But I think that this is all a feature of the system. It's not a bug, right? This is how the system is designed. And so for me personally, it's just, we got to get people educated so they know what to do to kind of position themselves to benefit like the wealthy are. But that's a big hill to climb.
But it's the intent. And one quick anecdote, Abigail, on this. So in the Grand Canyon, right? Went in to get breakfast at McDonald's because there's really no Wi-Fi, no cellular at the Grand Canyon. So tried to find some Wi-Fi and go to McDonald's. My son and I get 2 big breakfasts with hotcakes, cup of coffee, a juice, $12 in Chapel Hill. Pull up, the guy at McDonald's says, that'd be $28. So what are you talking about, $28? He says, yeah, well, our volumes are down, so we raise prices. I said, you can't do that. You're a national chain. He said, no, we're a franchise. We can do whatever we want. Think about it. So you're a park ranger, you're laid off because you don't have anybody there, and you got to go to McDonald's because you think it's cheap, and they've tripled the prices. That is messed up. And that is, as Pom said, that's the feature of the system. And the Fed, thinks, everyone believes the Fed is working in the interest of the little guy. They're exactly not, right? They are taxing the income and wealth of the poor and transferring it directly to the rich, to the banksters. And it's horrific. And getting worse.
Daniel, before I turn to Peter, did you want to say something?
Yeah, I think that is a great point that was just mentioned, is that there are by now numerous studies, a great one published actually by Bloomberg Economics, that shows how inflation for the lowest income brackets is between 2 times to 2.3 times higher than for the highest earners. And this obsession with increasing inflation has absolutely no evidence relative to what the economy needs. In a depression like the one that we're living in many cases right now, the fact that prices are not coming down is not a success. It's actually an absolute monstrosity that is making the poor have much larger problems to get out of the crisis. And that is the reason why in the last 3 decades, we get out of crisis slower, with lower productivity growth, and with weaker job creation.
So it seems to me that you really all are talking about this divide, this growing divide between the haves and the have-nots, which we see on every level out of this pandemic. And it also sounds to me, and I have this sense frequently over many years, that a lot of folks don't like the fact that what the Fed is doing to save the system at the expense of the little person, because you can, or the little guy, Main Street, because you can certainly make the case that all of the money from the financial crisis, went right into the financial system, into the banks, and then trickled through a little bit. But if you look at the velocity of money at all-time lows, and that's, I believe, I haven't looked at the velocity of money all that recently, but the less that it's moving, it tells you Main Street is really not moving. So Peter, I really want to bring you in, because I don't know this for a fact, but I believe that you think that there's a possibility that the system could actually collapse or come pretty close, which it sounds like, based on what Mark and Pomp and maybe not Daniel so much, that they would perhaps be aligned with you. So talk to us about your views on what you think is ahead for the system.
Well, first of all, I'm not really sure what you mean by the system, but if the system
Financial
is
system,
capitalism,
the entire
right?
financial system.
Right, but the Fed is not preserving capitalism; it's destroying it. I mean, it's trying to preserve, this, monstrosity that it's created through its interference with capitalism. I mean, all of the problems ever since Greenspan, took office, the Fed has been constantly inflating bubbles. It's been holding interest rates artificially low, and it has created some, severe systemic problems that underlie the economy. We are suffering the consequences of those problems now. That's why we were so vulnerable to COVID-19. The economy was so levered up, specifically because of the Fed. We had no savings for a rainy day because of how the Fed undermined that system. But, I disagree that Main Street is suffering. I mean, I don't think the suffering has barely begun, because you still have a lot of people, they may not have their jobs, but a lot of them still have their paychecks, which for a lot of people is an improvement. If you can get paid without working, for many people, that's better than having to work to get paid. In fact, there were people that were getting paid more not to work, because the Federal Reserve was able to replace people's lost incomes by printing money. But of course, there's zero productivity associated with that money printing. That's inflation. And when I believe the real pain is going to start on Main Street is when the purchasing power of the dollar collapses. That hasn't happened yet. So we've been able to postpone the pain with printing money. But sometime soon, I think the bottom is going to drop out of the dollar, and Americans are going to experience a much higher increase in the cost of living. And everybody is focused on demand. They're saying, well, prices can't go up because of demand. There's plenty of demand. The Federal Reserve is creating all that demand by printing money. But the other side of the coin that people forget about is supply. Less stuff is being produced. Fewer people working means fewer goods and services available to buy. And that's around the world. So you're having these disruptions of supply chain. So production is going down at the same time that production of money is going up. So you have fewer goods and services to buy and a lot of money to bid up prices. So I think prices are going dramatically higher. And that's when it really gets painful on Main Street. And, I expect the government to react to this situation probably the way they reacted in the 70s with price controls. I think price controls are coming. And what that means is shortages are coming. So it's not just going to be that goods are more expensive. They're just going to be impossible to buy. I mean, unless you buy them on the black market, which is what will happen, because then the only way you can get something is to buy it illegally, because there the price can reflect reality. But if the government tries to impose artificial price limits, well, then there's just nothing available to buy.
That's a very, very difficult situation that you're talking about there, for sure. And, something that comes to mind here around the Fed, just to go back in history a bit. So, the Fed was created after the panic of 1908 because JP Morgan at that time down on Wall Street, he did actually put money into the system, but he actually drove around in Wall Street throwing money around just to create the sense of confidence. And that was actually what quelled the panic of 1908. But the Fed was put into place because people didn't want these manias and panics, which we had seen many of. And then one of the most remarkable moments of history, and I'm going to take this opportunity to share it because I just love it, but FDR in his first fireside chat, prior to that fireside chat, that he turned, under Hoover, there had been tons of bank closures. And when the banks reopened, people would run on the banks and take their money because there was no confidence. Well, FDR took office, and right before his first fireside chat, there was a 2 or 3 day bank holiday. So it wasn't bank closures. It was actually a party. People were, exuberant, and they were enjoying that holiday. And they were planning on Monday, when the banks reopened, to go and do a run on the bank, to take their money out after they had had that bit of a break. But instead, FDR, in his first fireside chat, he said, and I want to try to imitate his voice, but I won't. But he said, hoarding money is so passe. That's what we've been doing over the last year or two, and it's so passe. It does not work. What we want to do is put our money in the banks, and we want to spend our money. Lo and behold, on Monday, when everybody was expecting a crash, instead, folks went to the banks and put it in their money. So FDR, just that talk of confidence, you could make the case he saved the system at that time, and then there was all the money put through.
I'm not going to defend FDR. I think he did a lot of damage to the capitalist system that America was founded on. And the Federal Reserve has done a great deal of damage. The U.S. economy was far more successful before the Fed than after the Fed. And in fact, the Federal Reserve that we have today bears no resemblance to the Federal Reserve that was created in 1913, because the original Federal Reserve, the Federal Reserve notes were backed 40% by gold and 100% by commercial paper. And the Federal Reserve was not allowed to own any U.S. government debt. It couldn't buy it. It couldn't hold it. So it was not created to be an engine of inflation. It was actually created for the opposite purpose it serves today. The original Federal Reserve Act, during a recession, the Federal Reserve was supposed to shrink money supply and raise interest rates. That was the purpose, to provide an elastic money supply, so that when the economy was expanding, money supply went up. But when the economy was contracting, money supply was supposed to contract, so that money supply was supposed to stay constant over the business cycle, and they were supposed to have stable prices, as opposed to the slow decline in prices that we had before the Fed. But instead, we've had massive inflation. The dollar has lost 99% of its value since the Fed was created, whereas before the Fed was created, you had over 100 years of history where the dollar gained value. It didn't lose purchasing power.
So Peter, you make
prices went down for over 100 years.
You make a great point, and I think that it's true that the Fed has gone away from the purpose of the initial Fed, especially from the idea of getting away from these manias, panics, and crashes, because we've certainly seen them. But we have, JP Morgan used the trick of confidence, FDR used it, Bernanke used it in a masterful way out of the financial crisis, even though I know a lot of people aren't perhaps a fan of all of the QE and this money put into the system. And this Fed right now, you can make the case that they've done it. So it seems time after time, a system built on confidence. And actually, I'd like to bring Mark
I agree. Just let me get one point. It is built on confidence. It's a con, right? That's what confidence is. It's a con job.
But the system is overall hasn't collapsed.
System is, but it's all built on confidence. It's not built on something real. Confidence is easy to lose. And once it's lost, it's gone for good. So we can have a complete monetary collapse once confidence in this system goes away. And it will go away because there's nothing real behind it.
That's why I'm citing these examples in history, because each time where we get into this difficult area, and you can make the case, this has happened right now. In March, we could have just absolutely gone into the collapse you're talking about, but the Fed and DC stepped in. So it seems to be working. Mark, do you think that it will continue to work? And also, if we bring stocks into the equation, because I, as you know, love charts, I could easily make the case for the collapse you're talking about, Peter. And I can also make the case that it's been sitting there latent in the S&P 500 chart for 10 years now, that we've been on borrowed time from the Fed. I personally am a fan of what the Fed's doing, only because they have saved the system for the majority. Yes, it has created a greater divide between the haves and the have-nots, but I would rather have some sort of stable system as opposed to none. Mark, what do you think about this conversation? And if you could bring,
I think the level of conspiracy theory thinking is pretty much off the charts. If I had to be blunt, the Fed wasn't. The only way you stop bubbles is to stop capitalism. It's in our nature. The reason we take risk is not the price of money. We've seen this. The craziest valuations we've ever seen in the stock market took place in the year 2000, when the Fed funds rate was 5.5. The craziest lending in the housing crisis took place from 2005 to 2007. Fed funds rate was 5. Right? The bubbles happen because, one, you have to feel confident in your own situation, that you're comfortable, and two, you have to see people around you making money. And then the greed kicks in. That's what happens. The price of money matters a lot less. And this is why we haven't seen all the things that Peter's been predicting for the past 15 years. because with interest rates at zero, because that's not what's driving people. Velocity is low, not because people decide it's low. The velocity is low is because the price of money doesn't matter to people when they have other concerns, right? So, and furthermore, the Fed was designed not to prevent bubbles, but to make sure the system would resist outright panics when the bubbles happened, right? So you can't kill a bubble unless you kill capitalism. All you can do through ideally macroprudential measures and good reserving and all those kinds of things. You have shock absorbers, you have foam on the runway when we get carried away with risk and when that pops, right? And it always does. Every cycle ends badly, right? So that's what they're supposed. That's what the Fed is supposed to do. That's what they've done, and that's why we haven't seen these things that keep getting, the hand waving about, oh, but it's going to happen tomorrow. It's going to happen tomorrow. Sometime that clock runs out. And for me, it ran out a while ago. We do have over financialization, but that's a regulatory issue. You don't need the Fed to create credit. You don't need Fed to create money. Base money and the money supply are very different things. Jim Grant, the hard money, the dean of hard money, even recognized a year or so ago that he was wrong in understanding how the Fed transmission mechanism worked. I'd submit to you that the people on the panel are making basically the same error. They think printing money equals money supply. No, you can create money. Shadow banking system did it with no reserves whatsoever. So it's a totally different. It's a totally different mindset. And I think if you look at the inequality issue, which is an important one, it's an extremely important one. Inequality started in the late 70s, early 80s. We couldn't even spell QE at that point, right? So you can make the argument, I don't even think it's a very strong one, that QE has exacerbated the income disparity because you have to factor in the role on housing of low interest rates, right? But you can't say that the Fed you certainly can't say that the Fed has created inequality. For me, it's very clear. The boom over the past 30 years has come from global financialization and technology. Both of these industries have increasing returns to scale. Mark Zuckerberg doesn't need to set up a new factory in Wichita. All he needs is more zeros and ones. And all of the marginal revenue accrues to a small group of people. If you're lending someone $10 million, you're lending them $100 million, you do the same due diligence, but the fees you get on $100 million are way bigger. So the two industries that led the global growth over the past 30 years, 40 years, have been ones where they're increasing returns to scale. All of the wealth gets into the hands of very few people, right? And of course, those people need to invest, and that's why we have an asset shortage.
Well, before we talk about how you're investing, you make a great point there. It sounds as though you think that these are the natural growing pains that come along with a shift, where going from the industrial revolution to the information.
To asset markets, and it's a lot more about the supply and demand.
There's nothing natural about it at all.
Daniel, I saw you shaking your head. Why were you shaking your head at what Mark was saying?
I mean, let's start from one thing is that there are bubbles when money supply growth is not prevalent. Absolutely, there are. It doesn't mean that there is a constant strive from central banks to perpetuate asset prices. And you know that asset prices are the main driver of central bank action when reducing.
It's not. It's a misconception, Daniel. It's a misconception. They want the economy to be solid, and when the economy is solid, what happens to asset prices?
No, they're trying to make the economy go up with a wealth effect. They're trying to push up asset prices first, and they think high asset prices is going to create growth. You have to understand how the Fed created both the dot-com bubble and the housing bubble. These were not natural phenomena, flaws of capitalism. The Federal Reserve did that. How do you think I knew that it was happening real time? I was calling out the Fed during the late 1990s. If you're predicting a collapse every year, sooner or later, you're going to get one. No, I'm not. You really don't know very much about what I've said. You haven't read my stuff or listened to me. But I called out the Federal Reserve under Greenspan during the dot-com bubble days when he was inflating the bubble, early in the housing bubble, when he was inflating. I was writing articles and talking about the housing bubble.
Okay, but who have you not called out
2008, warning about it, shorting subprime. I knew the Fed was creating this problem. You talk about the fact that rates got up to 5%, but Greenspan lowered them down to 1%. That's what really got it started. That's what gave birth to the teaser rate and the zero down mortgage. And then you had the securitization. You had the moral hazard supplied by Fannie and Freddie. That was not a failure of the free market. That was a
Mark,
result of government interference in the free market. And if you don't
Listen,
understand
Peter,
that,
one thing's
you don't
indisputable.
understand how much
The
damage the
bulk of the
government is
mortgage
doing now.
lending took place from 2005 to 2007 when the policy rate was at 5, right? So
But it was, no, but they
it might
still
have been
had
1%
all,
earlier, but that's what happened. And we know in the dot-com bubble, when the valuations got really crazy, that the policy rate was high as well.
Fed raised
We've seen plenty of
interest rates too slowly. They nurtured the bubble. The market peaked in 2005, right?
Guys,
Were you out there? Were you on television in 2004?
Guys, I would like to
warning about the housing bubble? Was that something that you were talking about? Were you blaming it on the Fed at that time?
Let's bring in another voice on this, because Mark Yusko, it sounds as though you may agree to some degree with Peter, but I would like to point out, and perhaps in agreement with Mark.
I don't agree with Peter at all. No.
Okay.
I have a different take. So my take is all about incentives. I mean, you're talking about JP Morgan as if he's some good guy. JP Morgan was an evil SOB. He was not a good guy. And, his best friend was John D. Rockefeller. John D. Rockefeller's father-in-law was Amory Aldrich. They hatched this plan to basically steal the wealth of the poor and give it to the rich. And that's what they've been doing since 1913. So there's a great book in 1910 written about the Aldrich plan that lays out exactly what was going to happen. It's exactly what has happened. So I want to go back to Mark's point, which I totally agree with one caveat, right? Divorce valuations in history are right now. Snowflake, which, full disclosure, I'm really happy about Snowflake because my son works there, but it's the dumbest thing I've ever seen people do in my investing career. To buy a stock for 227 times revenue, you cannot make money. There's no way you can make money. The math does not work. So we have the worst valuations in market history. But they're not even close. Cloud
in
stocks.
the aggregate, Mark. I was talking about in the aggregate. I'm not.
No. I agree with you, Mark. But
you might be able to find world.com or the globe.com or something from 2000 year that had a crazier one. I don't know. But in the aggregate, I'm pretty sure that the bubble we had in 2000 was orders of magnitude larger than what we have.
No, this one is bigger. This one is bigger than 2000.
Yeah, it's just marked out. The only subtle difference is I'm just looking at one indicator, which is enterprise value to sales, and we just surpassed the craziness of 2000, and people use this all the time. They say, well, we're not as bad as 2000. I'm like, that's like getting pulled over late at night for driving crazy and saying to the officer, well, geez, I'm not as drunk as the guy in the back seat. I had to drive. No,
okay,
you don't.
But we're saying different things. The big point I'm trying to make is this: that bubbles are driven by greed and the price of money within reason.
At the end, sure, but they get started by the Fed.
Plays a very small role, right? It's when we see other people around us making money, we say, I have to get in. If you remember the housing bubble, I mean, I remember I was there. Merrill Lynch said, we have to keep up with Goldman Sachs because they're making more money than we are. And guess what? They turned around to Countrywide and say, hey, can you print some more of those high yielders for us? And Countrywide turned around to other people and they did all kinds of bad things, right? But that's how these things happen. And even though the policy rate was at 5, they did it, right? They borrowed at 5.
Violent agreement. Yeah. Violent agreement.
And I called it out as it was happening.
Greed and fear. And greed and fear. And we are at all-time greed. Look at the day trading garbage. People literally picking Scrabble tiles out of a bag and buying that stock.
Yeah, but without the Fed, people would not have the confidence. People would be more risk adverse if the Fed didn't have their back.
That's not the Fed.
All of this
it's
is
human
a creation
nature.
of monetary policy.
Human nature. And this has nothing to do with the Fed.
You can go back to the tulip bubble a couple centuries ago. Pomp, I'd like to bring you into this conversation because you and Mark run $2 billion in money. So we've now brought stocks into the equation a little bit. So before we turn it over to currencies, where I think it's really happening, the dollar, and I'd like to ask you, in terms of Morgan Creek, from a portfolio standpoint, right now, how allocated are you to stocks? And it sounds as though, I haven't heard you say it as much as Mark, but it sounds as though Mark is sort of cautious on the overall environment, and 2021 could be really pretty difficult. So to me, that would suggest a lower allocation to stocks and that you'd want to go a little bit more defensive. So what are you guys thinking from an equity standpoint? Do you think that where do you think the S&P 500 is going to end at the end of this year, if you can make that call? And how are you positioning for 2021 relative to stocks and overall asset allocation? And Mark, if you want to jump in here.
No, I can't wait to hear Pomp's answer.
Okay, great.
Well, I was going to say,
numbers for the S&P.
just to be clear, Mark manages majority of that money. I just do work on the crypto side, so he can speak much more to exactly what.
Well, that's why I was saying he could jump in, but you're there, so
well,
I'm sure
but I mean, while Morgan Capital manages,
I like the
equities.
disclaimer.
Yeah. Here's my perspective. I tend to think that even last June, July, I was writing publicly saying there's a lot of alarm bells going off into Q3 and Q4. You obviously saw inverted yield curves. You saw the highest rate of CEOs leaving in a long time. It was very obvious that kind of we were getting late cycle type bells going off, and you can't time this stuff. I think Mark Dow, Mark, a bunch of people on here said nobody can predict that pandemic, but obviously there was going to be some pin that kind of popped this. And if you look at what happened in 2008, 2009, basically we've seen a repeat of that, right? Meaning that take an inflation hedge asset like gold, goes down 30% in the summer of 08. And during that, everyone is running for liquidity, right? That it's just that liquidity crisis. All correlations go towards one. The Fed eventually steps in. And when they step in, everyone fears inflation. Now, whether it happens or not, just the fear alone forces them into those inflation hedge assets. And then you see gold kind of from 09 to 11, basically go up over 200%, hit an all-time high. I tend to think the same thing plays out here, where people, whether inflation actually occurs or not, and the Fed has the aspiration of over 2%, I think people fear the inflation, and you kind of see that in the narrative, both on television, on Twitter, and elsewhere. And so people are going to run for those inflation hedge assets. What's interesting on this is the inflation hedge assets, somehow equities are serving in that bucket, which I don't think people would have naturally imagined. But also you see gold, Bitcoin, and other things playing into it. And so when you look from an asset allocation standpoint, the best performers this year, I think the S&P's up like 3 or 4% year to date. Gold's up about 22, 23%, and Bitcoin's up over 50%. And so I think what you're going to see is that's going to continue into next year and maybe even further along. And so equities, while they seem to be very volatile and kind of this upwards move off the bottom in March, they're really basically flat to pre-pandemic levels, right? We kind of dropped a bunch and then came back a bunch, but we're basically flat. Where you're really seeing kind of the benefit to a portfolio is in things like gold, Bitcoin, and real estate. And so I tend to think kind of along the lines of a Paul Tudor Jones, which is that whole bucket of assets is going to do really well over the next 12 to 24 months. It's just, what is your risk tolerance, right? So Peter will obviously be kind of in the gold bucket. I'm more in the Bitcoin bucket, but I tend to think that both assets will perform well. It's just how much risk can you take, how much volatility can you take, and then kind of what is your cash needs, right? So liquid real estate, all that kind of stuff. But I just think that if equities can continue to serve as this inflation hedge, they're interesting. The big question is, 200x multiples is unsustainable to some degree, and so kind of does the bottom fall out of that or not?
So I'll be curious to hear more about how equities are an inflation hedge. The cynic in me wants to say that fits the entire narrative that perhaps you all are talking about, so that you can allocate to equities. That's just, again, personal opinions, initial reaction, but I want to hear more about that. But I want to bring in Daniel. So Daniel, as an economist, either, I think it was Bernanke who termed the phrase, but we've seen it many times in history, but the virtuous cycle. So that cast we were talking about before, but you're saying we're not healthy. If you were to tie this into the stock market, because again, even if it's the least essential of the asset classes, the tail of the dog, and bonds and FX are somewhere in the middle in the head, what if you were to tie your economic view, first of all, this virtuous cycle right now, to me, just my perception, one person's perception, I agree with Peter that there could be a lot of downstream trickle through to come as businesses shutter and that sort of thing, if the confidence and the psychology doesn't stay here. But is this virtuous cycle, do you think that the one that we're seeing right now over the last 6 months, because the system hasn't collapsed yet, do you think that it can continue? And also, how do you tie that into the stock market?
Okay.
High, recession, a pandemic, and all-time highs for stocks.
Absolutely. Monetary policy is not a game of who wins. It's a game of who loses first. That is why the system doesn't collapse as long as the Federal Reserve continues to pay attention to the real demand for US dollars, which it is. So the reason why the doom scenarios don't happen is fundamentally because the rest of central banks globally, particularly in emerging markets, which had seen their currencies continue to collapse relative to the US dollar, despite the alleged weakness of the US dollar, the rest of central banks are doing things worse than the Federal Reserve with all of its problems. So that is a very important factor to understand where to allocate capital and equities.
So in other words, you think the US is the best house on a bad block? Is that?
It is absolutely the best house and the one with more doors. This is the most important factor. It's that it has liquidity and depth in the market, which none other, including the Eurozone, have. So I think that that is a very important factor when you think about what is safe and what is safer relative to other assets when you decide to invest in the portfolio. That's why equities, United States equities, continue to perform much better despite allegedly higher valuations than so-called value stocks globally. And they will continue to do so. Why? Because the entire issue that we have been talking about in the last few minutes is developing and showing clearly, like almost crystal water, in equities all over the world, is that while in the United States you have companies that have weakening earnings, absolutely they do, but not as bad as European young ones or emerging market ones. What you have is a game of relatives, and this is what we have to do as investors, is to decide where to put money. You have to put money in equities. You have to put it in the United States. Be there an election challenge or not, because everybody else is suffering from the much larger problem. So I think that on that side, I would continue to be invested in the United States. We were mentioning right now the safe havens. Safe havens continue to be extremely important, not just as good investment ideas, Bitcoin, gold, silver, etc., but because they are non-correlated assets in a portfolio. In one of the big problems that we'll find ourselves in is that the massive injections of liquidity drive as well a lot of investment into ETFs and passive investment, which, when the market turns, creates this downturn on almost anything. Central banks, by the way, not only just care about asset prices, they care a lot. They care so much that with bond yields at all-time lows in the Eurozone and in Japan, they increased their action because an increase of 10 basis points on the yields in Southern European bonds was intolerable. So we need to pay attention to that. Financial repression is always led by more financial repression. When that happens, you want to be in the house, in the bad block, with the biggest number of doors and with the biggest number of windows as well. That is the United States.
Mark, before I bring you in, I just want to bring in Peter, because Peter, I don't know enough about Euro-Pacific Capital to say for sure, but I'm imagining you have some exposure to stocks. I could be wrong on that. You may just be all gold, but I'm guessing that you have some exposure to stocks. And Daniel just made the case that you need to have exposure, if you're going to have exposure, to US stocks. So do you have exposure to US stocks? If you're able to give any sort of portfolio allocation to stocks, that would be terrific. And then how do you own stocks if you think the system is going to collapse? And you may not.
Yeah, well, first of all, we only have a small allocation to gold. And we have a larger allocation actually to gold mining stocks, but we do have broad, diversified global equity portfolios. I mean, I think stocks do represent an inflation hedge. I mean, stocks, to the extent that you buy the right ones. Yeah, well, stocks have real assets, right? They own plant and equipment, property. They have tangible businesses that generate revenue, where you can increase prices as inflation is eroding away the value of money. And also stocks have debt. And you have to realize that the biggest part of inflation is that it's a transfer of wealth from debtors to creditors. So when companies have debt and inflation destroys the value of that debt, wealth is being transferred from those bondholders to the equity investors. So we have significant exposure to stocks around the world. Now, that doesn't mean all stocks are going to be a good inflation hedge. I mean, you have stocks that are trading at crazy valuations. Those stocks could collapse. But when you can get these value stocks at good prices, there's a lot of stocks that we're buying around the world where we're getting 6, 7, 8, 9% dividend yields, where these stocks are actually trading at relatively attractive valuations. You know, it's not just a bubble like you have here, like in some of these NASDAQ stocks. But we don't have any exposure to the U.S. stock market. I think the U.S. stock market is not going to be a good inflation hedge. But I mean, if I had to choose between U.S. stocks, U.S. bonds, or U.S. currency, I would pick U.S. stocks. I mean, U.S. investors will lose a lot more money in bonds and in the bank account than they will in the S&P 500. But fortunately, it's a big world, and those are not my only choices. I think U.S. stocks are very expensive compared to the stocks I could buy overseas. I think corporate taxes are headed dramatically higher in the U.S., but not just on on corporations themselves, but on the American shareholders who own stock, because the personal income tax is going to go up on dividends and capital gains. So I think there's a lot of headwinds for the U.S. And I think as the U.S. gets into this horrible recession, you know, stagflation, it's going to undermine earnings of a lot of these companies in the United States. So I would much rather focus internationally. And I think the idea that America is the least dirty shirt in the hamper, I think that is an idea that is shared by almost everybody, right? That by default we win because everybody else is worse. I don't think that's true. I just think that's part of the conventional wisdom that is wrong. And it's part of this confidence game. And I think investors are in for a rude awakening when reality strikes. And just one thing I want to point out is, yeah, people should be owning gold and silver. I know a lot of people are talking about Bitcoin. I just think Bitcoin is part of the bubble. I mean, somebody earlier mentioned tulip mania. I mean, Bitcoin doesn't even have the value of a tulip. So I think a lot of people who think they're hedging themselves by owning Bitcoin will only go up so long as there's a supply of greater fools to buy it. But whenever you're involved in a greater fool pyramid, eventually you're the fool, and there's no greater fool, and you're the bag holder, and the bottom drops out.
You've certainly, you're inflaming Pomp and Mark there. Before I bring them into the
conversation. No, it's just that he's been saying that since it was $100. So,
well,
excuse me.
He's been saying that since it was $100. Now it's 10,000. But
before we go full on Bitcoin and gold,
you know,
Peter, I'd like to.
It'll be $100 again. So,
can I say one thing about monetary policy, and then we can move on to these other things? Because I think it's the most important lesson really over the past 10 years. When we got it, we had the great financial crisis in 2008, both the people who thought monetary policy could save us and the people who thought monetary policy could sink us were wrong. The big revelation of the past 10 years is that monetary policy is far less powerful than we thought. The reason stocks are high where they're high right now, they responded well and didn't respond nearly as quickly in 2008 is because of fiscal.
That's true.
With fiscal policy, you're spending money. With liquidity, you're just saying we have money available if you feel like lending it, right? But most of the time, when you're in crisis, people aren't going to want to lend it.
But we need a big clarification here. We haven't
had inflation. This is why we haven't had debasing of the currency, all the scenarios that Peter likes to talk about. And it's also why we didn't have a very fast recovery, because we didn't have the fiscal policy impulse in 2008, 2009, nearly as forcefully as we did just now. In large part, I think, because people learned monetary policy doesn't get it done.
Well, do you think that we still need more fiscal stimulus? It seems as though there's some political stuff going on the stall.
Those people, I think we need, people have referred to the K-shaped economy, and I think there's a lot to that. This crisis has done two things. It has exacerbated the haves and the have-nots, and it's also accelerated trends that were currently in place, right? So, and we have to offset those phenomena, both of which hurt the people at the bottom. They hurt the small shop owner, the people the service industry workers that have to show up. We need to take care. We need to take care of those guys. I look at these things. We talked about a cast. Monetary policy to a small degree and fiscal policy to a large degree buy us time. in the case of the GFC, they bought us time for balance sheets to heal because everybody got out over their skis, taking too much risk and borrowing too much, and also accumulating too many assets on a levered basis. This time, we're buying time to find a vaccine, to figure out protocols so we can get back to work, et cetera, et cetera. And but the big rebel, so I think it's important in that regard, and we need more. But what's really important is to recognize that monetary policy is far less powerful, in a good way and a bad way, than everyone thought 10 years ago.
Mark, I see you shaking.
I need two clarifications. So one, this discussion that stocks are up, it's not true, right? The average stock in the United States is dead flat for the last 7 years. 7 stocks are up. That's it. If you didn't own FAANG, Facebook, Amazon, Netflix, Google, Microsoft, NVIDIA, and
FAANG, I'm going to have to use that on air. I've not heard that.
FAANG. It's the only 7 stocks up the last 7 years. And China stocks are up almost 20% this year, with the US basically at 0. So Chinese equities are way more attractive than US equities. I agree with Peter that there's lots of stuff all around the world to buy. But the second clarification here is we're making the assumption, to use the cast analogy, that the bone was set right. The bone was not set right. So if we let it heal, it's going to be worse, not better. So we are going to OD the patient. We don't need more stimulus. We don't need more free money. We don't need UBI. We don't need to discourage innovation and wealth creation. We don't need to get people to sit home and not work and not be productive. We are going down the path of communism. Now, we call it socialism to make it sound good, but we are going straight down the path of communism. Dumbest idea in the world to give people money to do nothing. It's just idiotic, right? Capitalism works. What we have now is not capitalism. We have cronyism. Cronyism has been perpetuated by this system, exacerbated by the Fed, but mostly about the politicians and corruption. Look at Kodak, one of the biggest examples of corruption I've ever seen. I mean, just silly. And this idea that we're waiting for a vax. Okay, here's the thing. Let's just talk about science. Coronavirus causes the common cold, right? Novel coronaviruses cause worse things. But the coronavirus caused the common cold for hundreds of years, probably thousands of years. If it was able to have a vaccine, don't you think we'd have one?
Absolutely.
These things take time, though. But let me I've heard it mentioned a couple of times how the economy's being hurt because people are being paid to stay home. There have been a number of, which would you rather have, $100 in a one-time payment, or a future stream of years of $80 or $60, or pick a number, right? And they've done studies now that where they've broken this down carefully, like 5 different studies from different sources, showing that it's not disincentivizing people. People want the job. They want the stream of income.
They want the money and the leisure.
Not a one-off pay.
Leisure is very valuable.
No way.
Well,
I see no examples in any.
I'm not talking about
any time in history. Show me one example of any time in history where a movement towards communism worked.
There's no movement towards communism. I mean,
we are. If you make people equal, if you give people money for free, that's communism. It just is. It is.
Okay, jokes apart. These payments I'm talking about to the people who are getting hurt most by this, these are temporary payments to buy us time, to keep these people from defaulting on their mortgages, or to keep them paying rent, to keep them alive until we get the vaccine, or we get some kind of protocols, or we fix these things.
No, just unwind the idiotic lockdown. We don't need to. We've been dealing with viruses for thousands of years. We don't need to lock people in their homes. The word quarantine was invented in Venice, Italy, to take 40 days to put sick people in isolation. It didn't mean lock down the 99.92% of people who don't have the virus and who will never have the virus. If you don't lock things down, they will, right? As we saw here. No, they won't. We've never done a lockdown we don't do a lockdown for tuberculosis. We don't do a lockdown for HIV/AIDS. Will kill more people this year than COVID.
It's not airborne.
We don't lock people down for HIV/AIDS.
It's not airborne. You don't get it you don't get it by having dinner with. You don't get AIDS by having dinner with somebody, right? It's a very different phenomenon, right?
It's not.
I mean, you can disagree with the health experts all over the world. Mark, you can disagree with the best health experts in the world, right? But they're telling us to lock down. right? And at least initially until we figure it out. And now we're figuring out ways to get back to work. We have plexiglass.
Sweden. One word. Sweden.
Have masks.
My homeland. Sweden. Let's look at Sweden.
Yeah, I mean,
They have no deaths. They have no deaths.
It
right now,
sounds as
zero.
though there's some disagreement on the response here. Some people think that DC and the Fed probably panicked in March, and perhaps a case could be made that the eye was on the greater good. But, we have another big issue coming up that we haven't even touched on. And so I guess, we do have a little extra wiggle time here. So maybe if you all have the stamina and the energy to use it, we have the election coming up. And not only do we not know who is going to be elected, but we also don't even know when that result will come through. Pomp, how are you guys thinking about the election in terms of the uncertainty? And I would also love for you to bring back in Bitcoin, because I whether I should or not, I agree with Peter on Bitcoin. I don't have.
Oh, Abigail, we got to talk. We need to talk.
Well, so
Wow.
blockchain, I would love for the two of you to explain to me, because I've moderated a couple of panels on Bitcoin, and there are folks in my family who are big Bitcoin bulls. And blockchain, I'm told, a lot of people are like, Bitcoin I'm not sure about, but blockchain, the value of the technology is going to revolutionize the world. But nobody has articulated to me why blockchain is the next internet. So if you can do the election and blockchain and crypto together, that'd be great.
Yeah. So I think a couple of things, right? One is, if you look, I think it's 90 days out from the election. Basically, if stocks go up, the incumbent stays, majority of the time. If stocks go down, there's a change of power. And there's a lot of data points that suggest a change of power is coming, just in terms of the economic data. So stocks are down.
Well, actually, I just want to jump in there because I actually reported on this yesterday. And so or at least the data that I reported on is, so the 3 months before the election, if stocks go down, the incumbent is out. Now that includes the incumbent party. However, this year being this year, it's so interesting. So August up 10%, September down 10%. It all comes down to October in terms of that. We're literally basically flat now going into that time period. So I just wanted to throw that in there also.
Yeah. And so I think that what's different or interesting about what we're seeing is the incumbents basically have one more bullet in the chamber that they can shoot, which is a huge kind of stimulus package. What the impact of that is, if it plays out the same way that the kind of $3 trillion package played out, you could see stocks rally hard going into the election, but we just don't know, right?
Are you surprised that President Trump hasn't gotten that done? Because it does seem as though that would be...
I think that, and some of this is like, there's political perspectives on it, and then there's just like the economic perspective. And from a political perspective, when the kind of fifth stimulus package kind of fell apart, there were some executive orders, and there was kind of the best effort, if you will, in terms of what the president could do unilaterally. I do think that there's a package that'll get reached. I always call out the absurdity that our politicians are literally negotiating trillions of dollars. So they start out at $500 billion from the Republicans. Democrats start out about $3.5 trillion. They're getting closer and closer to the middle, and so I do think that there will be a compromise somewhere around $2 trillion or so. But the fact that right now we literally have two political parties that are over $1 trillion apart in their negotiation is pretty ridiculous, just from the magnitude of a lot of this. I think the key piece to this entire thing, though, right, is, and you mentioned it with Bitcoin. I think Peter, myself, Mark Yusko, it sounds like maybe Daniel, Mark Dow, maybe not as much, but we all would agree on a lot of the issues with the system, right? And we may have some variations of kind of why they happen or how they've played out. But for the most part, folks who are gold bugs, Bitcoiners, or otherwise, they agree on a lot of those challenges. And I think that when you look at that, then people say, okay, well, what should I do, right? What should I do with my portfolio in order to kind of respond or position myself? And for sure, gold bugs and Bitcoiners and others as well, but gold bugs and Bitcoiners for sure agree that sound money principles are a solution to the problem. I think where you get the divergence between, let's say, the gold community and the Bitcoin community is there's two ways to implement sound money principles, right? You can implement it in an analog version, which is gold, or you can implement it in a digital version, which is Bitcoin. There's a lot of debate as to the pros and cons of the analog versus the digital, whatever. it's both sound money principles, right?
Do you mind if so what is
There's
the value
nothing sound
behind
about Bitcoin.
Bitcoin? Because I would actually argue that I'm not sure what the value is behind gold. Historically, it's a store of value. It's beautiful. I love gold more than platinum. So, but I'm in the camp that I have a hard time knowing
Abigail,
what
scarcity.
the value is.
Yeah.
So what is the value behind Bitcoin?
Scarcity.
I think you've got to remember two things, right? So gold has basically two key components to it, right? One is there's a utility. You can use it for conduction. You can use it for jewelry. You can, all the things that we know gold can be used for from a utility standpoint. And then two is the narrative of scarcity, right? And for the most part, we've got pretty good educated guesses around what is the existing supply of gold? What's the daily incoming supply? It's hard to produce or to find. And so that kind of scarcity narrative has been very valuable for literally thousands of years. So you got utility and scarcity. When it comes to Bitcoin, it's the exact same thing. So the Bitcoin network, right? Not Bitcoin, the asset, but the settlement network or the payment network, it is the most secure computing network in the world. It has more computing power running it than any other computer in the world. The second piece is if you compare the transaction volume on the Bitcoin network to Apple Pay, PayPal, or Venmo last year, there was more usage of the Bitcoin network than on Apple Pay, PayPal, or Venmo. So it's literally being used more than many of the payment systems that we think of here in the United States as kind of, very important or
value
popular.
basis, right? That's on a value basis?
It's something called adjusted transaction volume, on-chain transaction volume. So literally, if you think about, you take out all the exchange traded volume, so no kind of speculative type transactions, and you also take out all the inflows and outflows to the actual exchange wallets. What they try to get at is, peer-to-peer stuff. So if I send Bitcoin to Mark, if Mark sends it back, what we don't know is what it's being used for. So am I just sending it to Mark, because I'm paying him back for something? Did we make a bet? Did, some other usage? But just the on-chain transaction volume is higher than Apple Pay, PayPal, or Venmo. Now, again,
so that's utility.
That's utility. And then you got the computing network. When you look at from a scarcity standpoint, and this is the part I think Peter and I, we love to debate, is finally in the digital application of sound money principles, we have something that's introduced called provable scarcity. And so what I mean by that is if I asked you how much gold exists in the world, we'll probably get close, right? We'll have an estimated guess, but we don't know exactly with 100% certainty and can point to the exact number of ounces of gold in the world. Right? With Bitcoin, we can literally look on this public ledger and see that the exact number of Bitcoin that are already out. We know that there's only 21 million. And then on a daily basis, if I said, hey, how much gold is actually being dug out of the ground? How much is being produced on a daily basis? We can maybe go to the mining stocks and see how much their kind of daily average production is or whatever. But you can't prove to me right now how much gold's coming out of the ground today. I can, on the Bitcoin network, prove the absolute scarcity of there are 900 Bitcoin that are going to get created today. And I can show it to you. And so this idea
Scarcity
of
is irrelevant when you don't actually have the value. The reason that it's important that gold is scarce is because no other metal that exists can do what gold does as well as gold does it. So there is
no other computing. Hold on, and no other computing network can do what Bitcoin can do.
But
and
there's an infinite number of cryptocurrencies that can be created that can be identical or superior to Bitcoin. I don't care about that network. As far as I'm concerned, that's all a bunch of malinvestment.
I know, but Peter, the beauty is
is only there so long as the Bitcoin bubble doesn't deflate. Once the beauty
is that your opinion and my opinion doesn't matter. The beauty is your opinion and my opinion doesn't matter. It is what the market has determined, and the market has determined
the market
that Bitcoin.
Hold on, until people wake up. But
hold on,
you want to lose
no, not from a price standpoint. Hold on, Peter.
That's up to you, but don't encourage other people to throw their money away.
Peter, this is an important thing. I'm not talking about the price of Bitcoin. The market has determined that Bitcoin, the settlement network, is the most superior way to transfer value globally.
You're not transferring value. You're transferring Bitcoin.
No, you're not. And Peter, this is the problem, right? If you just stop for a second, Abigail asked the most important question. No one's explained to her why this is the equivalent of the internet. I'll do it really quickly. Okay. Blockchain technology is an operating system. We've had operating systems change every 14 years. Why it's 14 years, I don't really understand. But in 1954, we had these things called mainframe computers, and they ran on COBOL and Fortran. And then 14 years later, we had a microchip, and then we had Sun workstations. Okay, 14 years later, we had the personal computer, and now we had DOS and Windows, disk operating system and Windows. 14 years later, we had the internet. The internet runs on TCP/IP. a protocol. That is the operating system for the internet. 14 years later, we have the mobile net. We all have these handheld supercomputers that we walk around with, and they are connected by iOS and Android. Blockchain is the operating system for the internet of value, and we are transferring value, Peter. It's very simple. Every asset in the world, every stock, every bond, every currency, every commodity, every asset in the world will be digitized. And once it's digitized, it goes from analog to electronic to digital. It will exchange over.
Right, but what does that have to do with Bitcoin?
And, wait, Peter, let me finish. And it will exchange any value anywhere in the world, and we will use the Bitcoin blockchain. Why? Because Paul Romer, who won the Nobel Prize 2 years ago, because of the law of increasing returns, what he said, and the reason he won the Nobel Prize, is it's not the best technology that wins. It's the technology that gets critical mass and creates a network effect. Bitcoin has won. Now, it's also won
if I want to transfer ownership of a real asset,
it is the most scarce asset in the world. And the reason that's important is because gold, money, any money in the world has no value behind it. There is no value behind the US dollar. There is no gold behind it. There's no silver behind it.
There's a difference.
There's no full faith in
gold
credit.
is money.
You don't get
gold
anything.
Has value.
No, gold has been money for 5,000 years. Why? Because
it has value.
Because it doesn't have value. It has no value. It is a rock. It is a rock.
No, it's not a rock.
It has no
first of all,
value.
it's a mineral.
It has no value.
Why do you have to know nothing about gold?
It has no value.
When you're in
It has
Bitcoin,
no value.
right?
It has value because you and I agree to exchange it for value. That's what creates value.
Objectively, you can do things with gold. People wanted gold. Gold was a valuable commodity long before it was money. It became money because it was such a valuable commodity, but it also possessed other qualities that made it better money than other commodities.
But Peter,
this is all a bunch of nonsense. This is a sales pitch for Bitcoin. Yes, everybody that knows Bitcoin needs to convince people to buy so they can sell. Yeah, I know. It's a pyramid scheme.
More people in the world
Peter,
use
you don't
Bitcoin.
even understand the word. It's not.
Hold on.
Yeah, I do understand the word.
Hold on. More people globally use Bitcoin to buy goods and services than they use gold.
No, they don't. They're not. Well,
are you kidding?
People aren't using gold to buy goods and services either. So they're not using either one to buy goods and services. Nobody uses gold to buy.
Do you have gold?
And the reason they're not is there's a lot of regulations. If it wasn't for government and all these anti-money laundering regulations, people would be using gold right now. It's the governments that are preventing technology from having gold circulate easily over the internet as money. That's governments that are doing that. That's not the market that's stopping that. But people are using gold as a store of value, and people are using gold in industry. They're using gold in jewelry, in aerospace, in dentistry. There's all sorts of uses for gold.
Commodity.
The only thing people are doing with Bitcoin is speculating on it. People are buying it because they think it's going to go up.
Nope. So this conversation has gotten very emotional, as you would expect, with gold and Bitcoin. Daniel, I'm guessing that you might be a little detached from both. So what's your view on gold versus Bitcoin?
Again, as an investor, what you want is something that has proven value as an asset that, on top of being decorrelated, also has a history of a certain level of value that you can attach to it. Undeniably, Bitcoin is on its way to becoming money. It's a startup currency.
Undeniably. Why is that undeniable?
Because of the things that Anthony and Mark were mentioning right now. It is true, and it's a fact that it's been consistently increasing in its usage as for transactions. That is a fact. But
so do you think by 2030, 2040, I'm just curious, I'm interested because you're an economist as opposed to somebody who is invested in Bitcoin, or maybe you are, I'm not sure.
No.
What's the timeline?
Well, that is the great question. I think that the entire, Mises, Hayek have written extensively about currencies and how a currency rises, grows, develops, and collapses. The most important thing right now is to understand whether this pattern of increased usage that was just mentioned continues. Okay, but so far, what is undeniable as well is that the volatility and the usage relative to fiat currencies globally, etc., remains very limited. That's nothing, no question. It doesn't take out the things that support it from being a currency in the future. I don't think it'll be fast. And the reason why I don't think it'll be fast is coming back to the point that I was mentioning before. We are seeing globally a debasement of most currencies. In a year in which we in many media have been talking about the alleged weak dollar, the dollar has strengthened against 96 currencies globally, and you have some of the largest currencies in the world falling 25%. So I think that what Bitcoin would need to prove is that it can remain stable and that it can remain widely used in order for citizens to make it money. And Peter was mentioning the difference of when something goes from being a commodity to being money. It's not magic. It happens gradually, and it's the most democratic principle in the world. No government can decide it. No central bank can decide it. The reason why all of us here decide to prefer a currency relative to another is exclusively because we know that the next person that we are going to transact with will use that currency. And that is, that's the beauty of money.
So beautifully said, Abigail. What Daniel just said is so perfect, right? The transition from commodity to money is the most democratic thing in the world. That is the essence. That settles the debate. So it's a democratic decision. The world will decide and has decided in many occasions, right? The pound sterling used to be the global world reserve currency. It is no longer. The Roman solidus used to be the most powerful currency in the world. In fact, the word solid comes from the solidus. You were a solid citizen if you had a solidus. Now it's a trinket. It's worthless. So what Daniel's, it's so beautiful. I wish we recorded it so we could spread it around the world, because I think we are
recording it.
But except Bitcoin's not going to skip over the commodity part and go directly to money.
And Mark Dow,
computing power is a commodity. Hold on a second, but Peter.
I don't have any computing power from my
time out. Hold on. This is really important. This is 2020. We live in a digital world. And although many people who did not grow up with a phone in their hand, entire generation of kids is growing up with this phone in their hand. This is the greatest commodity in the world, is the computing power in your hand. Every other one of these analog.
That's got nothing to do with Bitcoin.
Yep.
Okay, Mark Dow,
the strongest computing network in the world.
Mark, I'd like to bring you into this conversation, but I'd like to ask a question. So there's been much, and I can even say back in 2010, when I was on the finance side of things, I wrote a paper called The Lender of Last Resort Crisis, because I could make the case that after yields went way low, they could potentially spike higher, which would then, perhaps debase the dollar. I was pretty young in my career. I felt strongly and passionately about what I wrote there. I still think that it was good work. However, having seen us move through the financial crisis, now seeing us move through this pandemic, the dollar is still here. And I could make the case that the DXY from a chart perspective looks like it may, I don't know, but it may bounce back up to 100 or beyond. So do you think that the dollar will remain the reserve currency? And if not, what do you think is the replacement?
I think for our lifetime, it will remain the reserve currency. These things, when they change, and they do change over the long sweep of time, just take a long time. But the key point when I hear talk about Bitcoin and gold that comes to mind is, and this is, I think, the defining difference in money. You can pay taxes with dollars. You can't pay taxes with gold. You can't pay taxes with Bitcoin. You might be able to exchange your gold or your Bitcoin for a dollar amount with which to pay your taxes, but your taxes are denominated in dollars. Now, until 1971, the value of gold was fixed to the dollar. So in a sense, you could say, okay, that's when gold was still money. But that stopped happening. And the 5,000 years that people keep referring to refers to a period in which most of it had some form of a gold standard. We don't have that anymore, and I don't think anybody's going back to it. So if you can pay taxes with it, then it becomes valuable, because look at the volatility of these two assets. They've been tracking the stock market almost tick for tick, right? You really, even if it were legal tender, the volatility of the asset.
It's actually not true. Hold on.
That's where I disagree, though.
True. It's not true. The correlation of Bitcoin to the stock market is 0.15.
No, I mean recently, Mark. I'm talking about recently.
Oh, okay. Okay. Yeah. I mean,
phases, right? And if we over the recent, I'm going to say the recent 6 months, maybe we can, refine the time horizon. It's been trading more or less tick or tick. Gold as well, by the way. Gold usually over the long haul follows real yield.
Too much liquidity chasing too few assets.
I think
it's
the
not
dollars
the either, because it's not even. We make the liquidity. As I said, if Jim Grant says I was wrong, that liquidity does not leave the Federal Reserve System. I think other people will come around to recognize that too.
Yeah.
But on Bitcoin, if I could just add that, they always say you only have one chance to make a first impression. We had that with Bitcoin in 2017. Everybody took a look at it. You couldn't look at anything else, right? Look at Google Trend searches since then. No one's interested in Bitcoin. Now, maybe at some point it will pick up and people will become interested. And I know you can cite statistics, and I'd be interested in seeing them, with different definitions about how the transaction volume is going up. Interest is not. It seems to be that for 10 years there's never been a killer use case, a compelling application, apart from some fringe things. Like I said, no one seems to. I don't know anybody who uses Bitcoin on a regular basis.
I want to make a point.
Okay, here's the important point.
Let me just make this
Mark,
point.
No, just let me, Peter.
Okay.
Let me address Mark.
Peter,
and this is short. This is really short. This is really short. So, Mark, the point is that Bitcoin with a big B and Bitcoin with a little b. What we're talking about is the Bitcoin settlement network as opposed to Bitcoin the asset. The settlement network is growing like a weed. We can send you lots of data on that. And it's like TCP/IP. No one on this screen could explain to me how TCP/IP works, but no one cares because it is the internet. And in the future, Bitcoin will be the protocol on which the internet of value runs.
Okay, Peter,
I want to make, first of all,
there's a fundamental tension between ease of use and security, and I haven't seen that resolved. Now, maybe that changes, and maybe I'm wrong, and I'll change my mind if that happens. But up until now, I don't see the adoption that has been predicted, time and time again. Right? Maybe it'll be next year, along with Peter's collapse of the global economy. But it's until it happens, until I see it happening, I'm not going to believe it. And like I say, I'm
going to come hang out with you.
Peter, please, and then I actually want to
pick up an interest.
Something else before we
really
sign off.
Adopted on a broad basis, we would see the kind of pickup of Google searches the way we did in 2017.
Peter, 30 seconds.
Yeah, well, I have 2 points. One, yes, Bitcoin, its popularity did peak out at the end of 2017, as did its price. I think that was the apex of the bubble, and now it's a question of how long does it take for the remaining air to deflate. But on the question of the dollar, I do think the dollar's days as the primary reserve currency are numbered. I think the world is going to reject the dollar standard and go back to the gold standard. We were on the gold standard until 1971. We led the world astray onto the dollar standard because the dollar had been backed by gold, rather, in Bretton Woods. We conned the world into accepting dollars and holding dollars by promising to pay them gold for their dollars. But when we went off the gold standard in 71, that was basically the beginning of the end. And now I think the world is going to go back to gold. It's not going to go to the euro or the yen. That's not going to work either. Currencies are going to be backed by real money again, which is gold. And I'm certain that's going to happen.
We have 5 minutes left, and I want to, for lack of a better way to put it, pull a John Farrow, and that is to do a rapid fire with the 5 of you. So I'm going to ask 3 different questions, and just your first answer, we'll just go around and see where we all settle out. And I will I'll go in the order of starting with Peter. So Peter, your most loved asset class to invest in over the next year to 5 years?
I don't know. Maybe gold mining stocks, gold and silver stocks.
Pomp?
Bitcoin.
Most loved asset class?
Bitcoin.
Mark Yusko?
Bitcoin.
Daniel?
Dollar and gold.
Dollar and gold. That's an unusual answer. Mark Dow?
Unusual answer.
I don't have a great answer. I would say stocks, just because they tend to go up over time.
Okay. Our second question is your least favorite asset class, the asset class that you would suggest that all of the people watching us right now run from, not walk from, run from. Peter.
Bitcoin.
Tom.
You knew that was coming.
I'd go with oil.
Oil. Wow, I wish we had more time for this panel. Mark Yusko.
FAANG man, short FAANG man.
Short FAANG man. Wow, I really wish we had another hour. Daniel.
Just remember the word FAANG, fangs bite. It's their nature.
Daniel.
Oil companies, European banks. Don't touch them with a stick.
Mark Dow.
So I have a lot of sympathy for the oil call because it's clearly dying. You can debate the rate over at which it's dying, but I have sympathy for that. But I also think Bitcoin is going to die too. Gold over the longer horizon will.
We need a day for this panel.
And probably go down just because, there's a long memory of gold being worth something, being a monetary asset, and it isn't any longer. And these things tend to progress like science, one funeral at a time. So as the old people who still like gold die off, it too will die off. But I'm going to go with Bitcoin as my number one.
All right, Abigail, before we do the last question, all right, Mark, if Pomp and I come to California, can we swap you surfing lessons for Bitcoin lessons?
yeah. Although I'm not the best guy to learn surfing from, but sure.
All right, we're coming.
Okay.
We're coming.
And so now our third question, what keeps you up the most at night? Peter.
I don't know. Sometimes it's indigestion or heartburn.
You're liking the stay-at-home cook thing. Lots of good food out there in Connecticut. Pomp.
That's a great answer, Peter. I generally think one of the things we didn't talk a lot about here today, but just the lack of financial education in the United States and kind of globally is at the point now where it's a national emergency. Like we just have so many people who have no clue, not only the basics, but also we basically ask people to go to work every day and then come home and be a professional investor, right? Because of the way that inflation works and things like that. And so I think that if we could somehow figure out how to solve that at scale, we'd be in a much better place. But that's probably the biggest thing.
Mark Yusko.
Yeah, mine is two things, actually. One is the current administration. That actually gives me nightmares of just the stupidity that exists in Washington right now. And then the second thing is what I witnessed over the last 6 weeks. I'm telling you, I cannot put into words, and I cannot make you feel what I felt seeing the amount of homelessness, the amount of just dejection, pain, and just true fear that exists in this country right now. It was mind-numbing, and it literally is giving me nightmares.
Daniel.
I'm going BTS rising up the charts, obviously, and joke. And the most important, the thing that worries me the most is the fact that there's a rising wave of people that are supposed to know about history and economics that try to give some level of credence to the idea that MMT, modern monetary theory, would actually work.
Mark Dow.
Man.
For me, the deterioration of the societal fabric and income inequality, I think the two are linked, though, and this current administration has been a quantum leap down in that regard, for sure. And unfortunately, now that the rest of the world knows that we can elect somebody like this, regaining our global standing in a world where the U.S. is no longer 40% of GDP or of output, global output, we're only 20%. We need alliances and able to get things done to make the world a better place. And we've squandered so much credibility with this administration, we'll never be able to rebuild it.
Well, I'm so glad that you just mentioned wanting to make the world a better place. This was a terrific panel, and along the lines of wanting to make the world a better place, I encourage each of us, all of us, to think of one way to inspire somebody that you know to do something to pay forward good feeling as we go forth, because I agree that there could be difficult times ahead, but if we all put positive energy and action, more importantly, into the world, perhaps on a smaller level, we can fight that in a different way. But this was an absolutely great conversation. I think we succeeded in terms of having that trading desk talk. So thank you all. And now I'll turn it back over to Dale.
All I could say is, wow, Abigail, what a masterful job of you
guys.
handling all of this. And
Yeah, let me second that emotion. What Abigail just did is truly extraordinary. To manage this group of
Yeah.
rebels without a cause.
Absolutely.
Bravo. I mean, that was
I've got a
awesome.
cause.
Absolutely.
And I hope, Abigail, this doesn't keep you up at night after having this experience. But wow,
It was terrific. I was
really
a philosophy major. I loved to
Although
discuss.
the
It was
collapse of the
debate.
dollar
amazing.
will probably happen during our sleep because it'll happen in Asia.
well, your heartburn will wake you up so you could see it, Peter. I want to thank Pomp and Mark and Daniel and Mark Yusko. Peter, great to have you again. Abigail, you are, I'm a fan. And it
Thank
was
you.
great having you here to do this. No one could have done it any better. So thank you, everyone, for making this Trader Summit
Thanks, guys.
a special day.
Thanks.
Thank you.
Thank you.
Thanks, Peter. Thanks, Mark. Thanks, Pomp. Thanks, Daniel.
Thank you, everybody.
All right. So long.
Thanks, Abigail.
Great job.
Have great days.
See
Bye.
you guys.
Bye.
Thank you.